Real estate versus mutual funds, where should you invest? Welcome back to the channel. Today, we're diving into a hot topic that I get asked about all the time. Real estate versus mutual funds. Which one is the ultimate investment for building long-term wealth? Well, there's no one-size-fits-all answer, and that's why we'll be comparing these two popular investment options across various parameters, giving each a score so you can see how they stack up. We'll be looking at everything from historical returns to liquidity, risk factors, and even how much effort it takes to manage each investment. By the end of this video, you'll have a much clearer picture of which investment aligns better with your individual financial goals, risk tolerance, and investment timeline. So let's jump right in. For example, investing in a rental property can provide a steady income stream, but it requires active management and dealing with tenants. On the other hand, mutual funds offer diversification and professional management, but they come with market risks and management fees. We'll compare parameters like risk, return, and liquidity to help you make an informed decision. Both investments have their benefits and drawbacks, and it's crucial to understand them before making a choice. Alright, let's talk returns. Because at the end of the day, we're all here to grow our money, right? Historically, both real estate and mutual funds have put up pretty impressive numbers. The S&P 500, which is a good benchmark for mutual fund performance, has returned an average of around 10% annually over the long term. That's pretty incredible when you think about the power of compound interest. But hold on, real estate has been no slouch either. Depending on the market and the specific property, real estate has the potential to generate significant returns through appreciation, rental income, and even tax benefits. And let's be real, there's something tangible and satisfying about owning a piece of physical property. However, it's important to remember that past performance doesn't guarantee future returns. Both real estate and the stock market can be cyclical, experiencing periods of booms and busts. Real estate is influenced by factors like interest rates, local economic conditions, and even just plain old supply and demand. Mutual funds, on the other hand, are subject to the whims of the stock market, which can be influenced by a whole host of things like economic data, geopolitical events, and even just investor sentiment. But here's the thing. With mutual funds, you're inherently diversifying your investments across hundreds, if not thousands, of different stocks and bonds. This diversification helps spread your risk and potentially smooth out your returns over the long haul. Real estate, while a fantastic investment, can be less diversified, especially if you're putting all your eggs in one property or market. Now, when it comes to scoring, I'd give both real estate and mutual funds a solid 8 out of 10 for returns. Both have the potential to generate significant wealth over time, but it's crucial to remember that past performance is not indicative of future results. Your actual returns will depend on a variety of factors, including your investment strategy, market conditions, and your ability to stomach some risk. But hey, that's what makes investing so exciting, right? Let's talk about liquidity, which essentially means how easy it is to convert your investment into cold, hard cash. Now this is where things get interesting. When it comes to liquidity, mutual funds generally take the cake. Why? Because you can sell your shares on any given trading day and have access to your money relatively quickly, often within a few business days. This ease of access can be a lifesaver if you need to tap into your investments for an unexpected expense or simply want to rebalance your portfolio. Real estate, on the other hand, well, it's a different story. Selling a property takes time, and I mean a lot of time. We're talking months, not days. You need to find a buyer, negotiate a price, navigate inspections, appraisals, and a whole bunch of paperwork. It's not uncommon for the entire process to take several months, and that's if everything goes smoothly. Plus, you've got to factor in closing costs, real estate agent fees, and potentially even capital gains taxes, which can eat into your profits. Now, I'm not saying that real estate is a bad investment because of this. In fact, it's this very illiquidity that can make it a good long-term investment. Since you can't just cash out your property overnight, it forces you to be more disciplined and think long-term. But in terms of pure liquidity, mutual funds definitely have the edge. You have the flexibility to access your money quickly and easily, which can be a major advantage for some investors. So, in terms of scoring, I'd give mutual funds a solid 9 out of 10 for liquidity, while real estate would get a more modest 6 out of 10. It's important to choose investments that align with your individual liquidity needs and financial goals. Now, let's talk about the elephant in the room, the one thing that can be a major barrier to entry for many investors: the initial investment required. When it comes to real estate, well, let's just say it's not exactly known for being cheap. Depending on where you're looking to buy, you're probably going to need a hefty down payment, often anywhere from 10 to 20% of the purchase price. For example, on a $300,000 home, that's $30,000 to $60,000 up front. And then there are closing costs, property taxes, insurance, and potentially even renovations and repairs. It all adds up quickly. Real estate can be quite unaffordable for many. But here's the thing. Real estate offers something that's pretty unique: leverage. You can actually control an asset worth hundreds of thousands, if not millions of dollars, with a relatively small amount of your own money down. Now, leverage can be a double-edged sword. It can amplify your returns, but it can also magnify your losses. Mutual funds, on the other hand, generally have a much lower barrier to entry. You can start investing in many mutual funds with just a few $100s, and some even allow you to get started with as little as $50 a month. Imagine starting with just $500. This makes mutual funds a much more accessible investment option for those of us who don't have tens of thousands of dollars lying around to drop on a down payment. So, when it comes to scoring, I'd give mutual funds an 8 out of 10 for their low barrier to entry, while real estate would get a 5 out of 10. While the high cost of entry for real estate can be daunting, it's important to remember that it's a long-term game. And with the right strategy, real estate can be a powerful wealth-building tool. Let's face it, every investment comes with some level of risk. The name of the game is to understand those risks and make informed decisions that align with your risk tolerance. Real estate, while often seen as a safe and stable investment, does come with its fair share of risks. Property values can fluctuate, interest rates can rise, and you might find yourself dealing with unexpected repairs, vacancies, or even difficult tenants. There's also the risk of natural disasters damaging your property. Plus, real estate is not exactly known for its liquidity, so if you need to cash out quickly, you might be forced to sell at a loss. And let's not forget the potential for fraud in real estate transactions. Mutual funds, on the other hand, are subject to market volatility. The value of your investments can go up and down in the short term, and there's always the risk of losing money, especially if you're invested in more aggressive, growth-oriented funds. Market risk is a significant factor here. However, mutual funds offer built-in diversification, which can help mitigate some of that risk. But be aware of the potential for fund manager fraud. By spreading your investments across a basket of different stocks and bonds, you're not putting all your eggs in one basket. Plus, mutual funds are generally more liquid than real estate, so you have the flexibility to adjust your portfolio or cash out if needed. Regulatory protections in mutual funds are also stronger compared to real estate. So, how do we score these two investment titans in terms of risk? It's a tough one, as both come with their own unique set of risks and potential rewards. I'd give both real estate and mutual funds a 7 out of 10 for risk. The key is to understand the specific risks associated with each investment and make informed decisions that align with your individual risk tolerance and investment timeline. Let's be real, nobody wants to be chained to their investments 24/7. We've got lives to live, people to see, and Netflix shows to binge watch. So, how do real estate and mutual funds stack up in terms of management effort? Well, mutual funds are pretty much the epitome of passive investing. Once you've chosen your funds and set up your investment plan, you can pretty much sit back, relax, and let your money work for you. Of course, it's still a good idea to review your portfolio periodically and make adjustments as needed. But overall, mutual funds require minimal effort on your part. Real estate, on the other hand, can be a much more hands-on investment. If you're renting out your property, you'll be responsible for finding tenants, collecting rent, handling maintenance requests, and dealing with any issues that arise. It can be a lot of work, especially if you're managing multiple properties. Now, you can always hire a property manager to handle the day-to-day tasks, but that's an added expense that will eat into your profits. So when it comes to management effort, mutual funds are the clear winner. They offer a truly passive investment experience, while real estate can be much more demanding. In terms of scoring, I'd give mutual funds a solid 9 out of 10 for their low management effort, while real estate would get a 5 out of 10. If you're looking for a truly set-it-and-forget-it investment, mutual funds are the way to go. But if you're willing to put in the time and effort, real estate can be a rewarding investment both financially and personally. For mutual funds, the work mainly involves selecting the right funds and occasionally rebalancing your portfolio. In contrast, real estate requires ongoing management, from tenant issues to property maintenance. The passive income from mutual funds is truly passive, requiring little to no effort after the initial setup. Real estate, however, demands continuous involvement, making it a more active form of investment. So, if you value your time and prefer a hands-off approach, mutual funds are the clear winner. But if you're up for the challenge and enjoy being hands-on, real estate can offer significant rewards. So there you have it. We've compared real estate and mutual funds across several key parameters: returns, liquidity, investment required, risk, management effort, long-term returns, tax benefits, and diversification. As you can see, there's no clear-cut winner. The best investment for you will depend on your individual financial goals, risk tolerance, investment timeline, and how much time and effort you're willing to put in. If you're looking for a passive investment with low barriers to entry, high liquidity, and tax benefits, mutual funds might be a good fit for you. If you're willing to roll up your sleeves, take on more risk, and potentially reap the rewards of leverage and tangible assets, real estate could be the way to go. In terms of long-term returns, real estate has historically shown strong appreciation, but mutual funds offer diversification and professional management. Ultimately, the most important thing is to invest your money wisely and make choices that align with your overall financial plan. Don't forget to let me know your thoughts in the comments below. Which investment do you prefer? Real estate or mutual funds? And why? I'm always down for a good discussion. And if you enjoyed this video and found it helpful, be sure to give it a thumbs up, subscribe to the channel for more personal finance and investing content, and hit that notification bell so you never miss an upload. Thanks for watching.